In this week's AMT Insights, I'll be discussing the worsening global shipping crisis and its implications for the broader metals industry. So firstly, you can see from these two charts here on my left that global freight rates both for bulk and container shipping have surged since late 2020. You can see that container freight rate shipping costs on east to west trade routes are up by almost 5 times the equivalent from last year. And if you look at bulk freight costs, you see the Baltic Dry Index here surged higher, and that's particularly in recent days actually after the Ningbo Port park closure, which we'll come on to and explain in a minute. Now, what are the broader drivers behind this shipping chaos? Well, firstly, they're demand driven. So the stimulus-fueled surge in consumer demand and industrial production has fueled record global trade volumes. You've seen the US and Europe have both driven demand growth in 2021 as China's growth has started to moderate a little. And the vast asymmetry in trade flows that has resulted from that difference in growth between regions has created a lot of capacity and demand in the wrong places for where it's really required. So, for example, empty shipping containers in the wrong places. Secondly, the reason for this shipping chaos is a supplier capacity issue. So, increased shipping times because of COVID-related port congestions and checks have reduced the effective global shipping capacity. Added to that, you've had disruptions such as the blockage of the Suez Canal and the disruptive aftermath of that on shipping scheduling and port congestion earlier this year. And you followed that up with more recently in Asia, more port disruption. So in Yanshan port in Shanghai, that was closed in May temporarily because of COVID cases. You've seen generally more congestion around Asian ports because of the COVID case pickup we've seen in the region. And more recently, which we'll move on to now, is the Ningbo Port park closure that we saw from early August. So on the 11th of August, China shut the Meishan terminal at this port, Ningbo Port, and this is the world's third busiest port. The closed terminal, which is pictured here on my left again, deals with about 25% of the port's cargo. So the port overall, after rescheduling where the ships are going, some of them are going to some of the other terminals, it's operating at around 90% of July's levels. That's quite a significant dip. And this port's quite important for the exports of electronics, for manufactured goods, for textiles, and also for the imports of raw materials and electronics. But raw materials, for example, can include nickel ore. It's a major destination in China for the ore coming in from abroad. This port might not return to normal capacity until early September, and regional ports such as Shanghai and Hong Kong are already feeling the strain of companies redirecting their cargoes to other regional locations, other regional ports. Major ports globally also foresee a big knock-on impact on trade flows and on shipping schedules again because of this disruption, both in Ningbo but more broadly in Asia on schedules. So what does this all mean for metals? Well, the shipping chaos really impacts metals in 3 major ways. Firstly, it's the shipping of raw materials. And that includes concentrate, scrap and ore, for example. So Peru, for example, is having issues exporting zinc concentrates and they're typically seeing 2-month delays in order to be able to ship that material to countries like China. And that's kept treatment charges under pressure. Notably, you see that for zinc on my left again, even though they started picking up from kind of mid-June this year, they've really remained quite capped because of this ongoing difficulty in securing reliable sources of concentrate. Now, secondly, metals industry can be impacted via the impact on shipping of metal itself. So that's been made more difficult. It's really inhibited the global market rebalancing via physical arbitrage. So it's too expensive for people to move metal where there's oversupply to where there's maybe not enough for it to be efficient. The lead market's been a notable example. You've seen a big glut in supply in China, evidenced by big pickups in SHFE inventories, and at the same time declines in LME inventories in tight markets in the US and in Europe. And that's kept regional premiums for lead quite well supported, and LME prices quite well supported for lead. But more generally for metals, it's kept regional premiums quite well supported. So you look at aluminium and tin, for example, as well as metals where that's been the case. The third way that impact metal markets, perhaps in a more negative way, is really indirectly through the potential impact on economic growth. So shipping chaos has affected the flow of goods, it's affected the flow of semi-finished products, and that's really disrupted the proper functioning of supply chains and risks doing so further. That can weigh on global industrial activity and present a threat to the broader economic rebound from the pandemic. That can therefore have a knock-on impact potentially on metals demand as well and on risk appetite, and that's something that is a potential impact for metals prices as well. So in conclusion, we think shipping chaos could be extended well into 2022, and that's both part due to the Ningbo Port disruption that we've seen, the ongoing pressures on shipping capacity, and the demand you're likely to see ahead of the Christmas holiday season, particularly in the next few months. That could all add to the pressures there. Secondly, we're likely to see treatment charges capped for concentrate, smelter treatment charges, and that's because of the ongoing difficulties we'd like to see in the shipping of concentrate and the ongoing uncertainty there. Thirdly, we'd like to see regional metal premiums supported, again because of this issue really moving metal from where there might be more supply, like in Asia for example, to regions like Europe and the US where maybe there's less domestic inventory and the replacement costs of bringing in that new inventory from elsewhere are going to be made quite high because of this freight cost and freight disruption. Finally, we think that the growth of the economy and the recovery from the pandemic is something that could be at risk as well because of this ongoing supply disruption. It really just underlines the difficulty that the globe has had in recovering from the pandemic, and issues like global shipping disruption being extended really add to the kind of feeling that this is going to be something that we'll be dealing with for a relatively long time. So this impact on potential economic growth and industrial activity could ultimately weigh on metals consumption and prices as well. And perhaps we saw that last week with the sell-off in prices, that was becoming a bit of a factor as well.